Hey guys, Joel Franklin, market analyst for YouTrading, and in today's video, we're going to be taking a quick look across markets. I'm going to be giving you a bit of an update, and we're going to be talking about what events we have coming up in the week and how things can shape up. Um, and actually, I think I probably want to start with a quick overview of the economic calendar this week because it is a very big week that we've got coming up. So let's go through things chronologically. The first really important piece of data that we've got is this US CPI data, which is coming out on Tuesday. Now, the PPI data that we got last Friday was a little bit hotter than expected, but it still did show US price pressures faced by producers falling. Not as much as expected, which is a bit of a disappointment for the market, but still did show them falling. And we're expecting as well to see the price pressures faced by consumers falling as well. So year over year inflation rate to drop from 7.7 to 7.3%, month over month 0.4 to 0.3%. So if these numbers did come in sort of as expected, that would be a relief to the market because we just want to continue seeing confirmation of that peak inflation narrative. And that's a fast drop, 7.7 to 7.3%. That's quite a quick drop. Like you only need, not even 1 year of drops that big. And you can pretty much be talking about inflation being back to close to the Fed's target. But anyway, we've got UK CPI following up as well on Wednesday, and then we've got the Fed meeting, new economic projections, new dot plot, 50 basis point rate hike expected. Powell in the post-meeting press conference, as always. And then, we've got a couple of other important data points as well out of other G10 countries like New Zealand GDP, Aussie jobs. And then we've got loads more central banks on Thursday, like the SNB, the Bank of England, the ECB, and I think we actually also had the Norges Bank as well, and there might have been another, but not as important. But anyway, moving on to Friday, flash PMIs out of the Eurozone, the UK, and the US. So there's a lot to be thinking about this week. Um, Markets, for what it's worth this morning, are kind of in a bit of a wait and see mode within recent ranges. You can see here the Dixie's hovering in sort of just below 104.50 within recent ranges. Um, the Dixie is in a downtrend quite clearly still. Um, it's not the most beautiful downtrend to draw up, but it is pretty obvious. And we're looking for confirmation of, for example, if we continue to see US inflation falling rapidly, and if the Fed does slow the pace of interest rate hikes, which is very much priced in now, and indicate a less aggressive approach heading going forward, then this trend seems to be the path of least resistance for now. Like we've had this break below the 200-day moving average, which was a sustained break, so a bit of technical selling likely to come in as well. But if we get a bigger upside inflation surprise and a hawkish sounding Fed, maybe we could test that 200-day moving average once again and break above it. We're going to have to wait and see how things shake out. Um, in terms of the S&P 500, we failed to get above the 200-day moving average. So it's not like the Dixie, which did see a break of its 200-day moving average. The S&P 500 hasn't. Investors not confident enough to keep it above 4,000 for now. But I think you can probably argue that we are still just about in this uptrend, this grinding uptrend from early October. And if the conditions are met, which I just talked about for the dollar continuing to move lower, then I think there's a good chance that you could probably see stocks rallying back above 4,000 and testing their 200-day moving average. Finally, let's have a quick look at oil. Very much on the precipice of a break below $70 per barrel in WTI. Something I've been warning about for quite some time. Because, we've had some optimism recently that China might be backing off from their zero coronavirus stance, but how does that manifest itself in reality? Well, if they're taking less strict measures to control the spread of coronavirus, you're going to see a rapid spread of the virus, which is exactly what we're seeing right now. How are Chinese authorities going to react to that? Well, we're going to have to wait and see, but it's certainly not good for the Chinese economy. We've got some important Chinese data coming out this week as well, by the way, so that's another thing to keep an eye on. And as we're upping our bets for a recession in other parts of the world, like the US and Europe, arguably probably already in a recession, or parts of Europe, the US potentially to follow next year, and China seeing a surge in coronavirus cases, even if the lockdowns and stuff that they implement aren't as tough. Surging coronavirus cases do still hit oil demand because they basically reduce the amount of mobility that people want to do. It has this chilling effect on society. I mean, we all remember it from when the West was going through it. But anyway, the macro picture for oil's still very much demand side driven, and I think we can hit this target to the downside in the form of these lows in sort of mid to late 2021 in the low 60s. I think that's a very reasonable thing to hit. Maybe not before the end of the year because it's quite a big drop from current levels. Um, and you know, if you continue to see the dollar weakening and stocks grinding higher, then that's actually a positive for oil. But I think we could definitely be looking at testing these levels in early 2021. But anyway, guys, that's pretty much everything I think that we've got coming up this week. All the major things anyway. So I hope you all enjoyed the video, and I will see you all in the next one.